Hello.
Hello.
Yes, how well can you hear me?
Not very good.
Uh, let's see. Is it any better?
Yes, it is.
All right. So we have been talking about investment appraisal. This is the outline of chapter 10. All the ticked portions or all the ticked units we have taken. So 10.1 financial statements, 10.2 analysis of published accounts, then 10.3 that's where we are, investment appraisal. We have just 10.4 to go and we'll be done with this chapter, which is the chapter that I think is most challenging because of the several formulas that we have to commit to our memory, and also some of the concepts that may be a little challenging to understand. But I believe that proper preparation would ensure that we excel in our exam. So today, last time we talked about the basic concept of investment appraisal. Under the basic concept, we talked about two methods of appraising investments. We talked about the payback method, and then we also talked about the last time we met, we talked about the accounting rate of return. So that's where we are. Today we will continue with today we'll continue with the third one, the discounted cash flow model. So like I said, we've already taken a look at the payback model. We've looked at the accounting rate of return, and today we'll look at the discounted cash flow model. These um, under the basic methods of appraising investments. I don't think that there's a need for us to go back and talk about what an investment is, what qualifies to be an investment, the different types of investment that we have. I've already explained that. And if you have any difficulty, I think you can go back to the slides or you can go back to the previous video to revise on all of that. So we'll just go straight to our lesson for today. It should be a very short lesson, which is the third method of appraising investments. Remember, I said that to appraise means to assess. We are assessing an investment opportunity, and we want to know as a business whether it is worth our capital. I remember saying that businesses put their capital to use to acquire assets, to expand their business, and to invest, basically. And it is necessary that for every investment opportunity, the business would appraise, would assess whether it is worthy of putting its capital to that investment. So today we'll look at the third one, the third and final one, the discounted cash flow method, or the discounted cash flow model. So I want to start by saying that this discounted cash flow model, well, it means that we are going to be discounting cash. Let me start from there. We will be discounting cash. We will be discounting cash. What does discount mean? If you go to a shop and you ask for a discount on something that you want to buy, you are asking for a reduction in value. So by discounting cash, we would be reducing the value of money, so to speak. So let's look at how we can do that. The first point, that I would like to make is that the technique or this discounted cash flow model is based on the time value of money. Is based on the time value of money. So we'll look at what we mean by time value of money, and we can understand what the discounted cash flow is, which I said is basically to reduce the value of cash. So what is the time value of money? That's the second point here. It says that the time value of money is based on the principle that money at the present time is worth more than money at some point in future. Let's read that again. Let it sink in. Money at the present time is worth more than money at some point in the future. So if we have money today, when you go to business school, you would hear finance people say $1 today is worth more than $1 tomorrow. $1 today is worth more than $1 tomorrow. And that's what our third point is saying. That basically $1,000 today is greater than the value of $1,000 in 1 or 2 years' time. If I have $1,000 today, its value is greater than $1,000 in 2 years' time. And let me use savings to explain this. It's very simple. If I say I will give you $1,000 today, or I will give you $1,000 in 2 years, what would you choose? And why? This is a question to you. If I say I will give you $1,000 today, or I will give you $1,000 in 2 years' time or in a year's time, what would you choose?
I would choose $1,000 today because $1,000 today might be able to buy a lot more than $1,000 in a few years.
Exactly. You've spoken like an economist. In a few years' time, whatever you want to buy with $1,000 might be expensive, might be more than $1,000. All right. So you would prefer that I give you $1,000 today if it can buy an iPhone or a piece of land, whatever. Next year or 2 years' time, you would go and that piece of land is no longer $1,000, it is 1,500. That means that the $1,000 would have been better if you had received it the year before when the value of that item was still $1,000. Now, however, there is another reason why this is so. Number one, it is because of risk. What we mean, what we are saying is that if we have $1,000 today and we or $1,000 today will be better than say $1,000 in 2 years' time, which is in an investment. If we put that same $1,000 in an investment, something could go wrong. The investment may fail. There could be several reasons why the investment may fail. Here we are saying that it could be due to competition from another business. It could be due to changing tastes. So whatever it is that we invested in, people are not buying, or it could be due to technological advancement. There are better ways of doing, or there are better products that have come out since we invested in a particular product. So if we put $1,000 into an investment today, or we put $1,000 into a savings account, the $1,000 today is worth more than the $1,000 in the future because if we put it in an investment, it could fail. Why? Because future payments are not guaranteed. Future payments are uncertain. All right. So because of risk, $1,000 today is worth more than $1,000 in a year or two time. Then the second reason is because of opportunity cost. because of opportunity cost. If we put that $1,000 into an investment, into an interest saving, an interest bearing account, that $1,000 could generate a return. If we put $1,000 into an interest bearing account, that $1,000 could generate an interest or a return. So it says here that opportunity cost is the best foregone alternative. We looked at opportunity cost at the AS level, we know what it means. Even if no risk existed, the first point says that because of risk, because a project could fail and future payments are uncertain. However, even if no risk existed, the time value of money would still exist. That means that even if there is no risk, $1,000 is of greater value today than $1,000 in 1 or 2 years' time. Why? Because that $1,000 today could be placed in an interest-bearing account. And if the money here, it says, if the money is invested at an interest rate of 5%, it is worth less today than its future value. If it is worth less today than its future value. So 1,000 in a year is equivalent to $953 today. What do we mean? If at 5%, if we put $953 into an account today, it will give us that $1,000 in a year's time. That means that the value of $1,000 in 1 year's time is $953. If I have $1,000 today and I put it into an interest-bearing account or into a savings account, it will be worth more than $1,000 in a year's time. So if I have $1,000 today, it is worth more today than in 1 year's time. If I give you $1,000 after a year and I give you $1,000 today, like you said, you prefer $1,000 today because what can you do with $1,000 today? You can put it in a risk-free investment, say a savings account, and earn an interest rate of 5% or less or even more on your account or on your money. So if I give you 1,000 today, it will be worth greater, or in a year's time is worth more. So that means that this $1,000 that I promise to give you in a year's time, like I said, and you preferred the $1,000 today, that $1,000 in 1 year's time is of less value than the $1,000 today. So these are the two reasons why we say that, or these are the two reasons, or this explains why we say that time, the value of money changes relative to time, or this explains the time value of money, which is that $1,000 today is of greater value than $1,000 in a year's time. All right, let's look at an illustration of this. This time value principle means that the longer the delay before money is received, the lower its value in present day terms. That is, the longer the delay before money is received. So the $1,000 that I said I would give in a year's time, if I delay it to 5 years' time, that means that it is not the same as giving you $1,000 today. Because imagine putting $1,000 in an account today, in 5 years' time, it is going to earn some interest and its value will be more than $1,000. So it is better we receive it today than to delay. So let's look at an illustration of this. So we have two investment options. We have investment A and investment B, both in thousands of dollars. and investment A would require that now we put $500,000 into it. $500,000. Investment B also requires an investment or a cash outflow of $500,000. So two investments, A and B. Now, these are the costs of the investment. Perhaps we're buying a machine, or perhaps we are buying part of a business or another business, and both of them cost the same amount. However, let's look at their cash flows. For investment A, in a year's time, it will give us $400,000. However, we would receive only $100,000 for investment B. In fact, it is not until year 4 that the investment B is giving us a cash flow equivalent to the cash flow that we received from investment A in its first year. So there has been a delay. This 400,000 is in the first year, this 400,000 is in the fourth year. If you ask any sane person, if you ask any smart person, a smart person would want, give me that $400,000 now instead of giving it to me in 4 years' time. Why? Because it is worth more to me now than in 4 years' time, like you said. So that means that the present value of this $400,000 is greater than the present value of this $400,000, which we will receive in 4 years' time. What is the present value of this 400,000? We will look at how to calculate the present value of this 400,000. However, what we are saying is that it is greater. It is of much greater value in a year's time than in 4 years' time. So this is a very important concept in appraising investments. If I have two investments and one is giving me very good cash flows from the onset compared to the other one, which is giving me good cash flows later in the life of the investment, I would rather choose investment A than choose investment B because of the cash flow, the cash payouts from the first investment. So let's look at the conclusion here. It says that the time value principle would suggest that project A is preferable. Project A is preferable. Why? Because it has a better present value of the cash flows. It has a greater present value of cash flows. So it is preferable than to project B. To show the effect of the time value principle, we need to calculate the present value of cash inflows and outflows through the use of discounting. That's why we call this method the discounted cash flow method, or the discounted cash flow model. So we have a series of cash flows, and by now we understand what cash flows are. This in brackets here represents a negative figure. That means that cash is going out. All right. So that is the cost of the investment. How much would the investment cost now? $500,000. What are the cash flows? Cash inflows. How much cash will be coming in terms of perhaps sales or returns from the investment? It is 400,000 for the first year for investment A, 100,000 to 100,000 for the third year, and 100,000 for the fourth year, compared to investment B, which looks rather the opposite of what we have here in investment A. So, what is the present value of 400,000 that we'll receive in a year's time? If, in other words, and pay attention to this, how much money must I put in a bank so that in 1 year's time I will get 400,000? How much money should I invest today so that I would get 400,000 in a year's time? That money will be greater than how much money I need to put into an investment, which will give me the same 400,000 in 4 years. So the present value of 100,000 in year 1 is greater than the present value of 100,000 in year 4 here. How do we know? We would know after we would discount the cash flows. We would reduce the value of the cash, and then we will check which one is greater. That's what we mean by discounting. So let's look at it. Let's look at discounting. Let's look at discounting. All right. So discounting is the process of adjusting the value of money received at some future date to its present value. All right. Discounting is adjusting the value of money. It's adjusting the value of money. All right. Like I use the shop scenario. If you want a discount at a shop, you are adjusting the value. The thing costs 500. You say, won't you give me a discount? Then say, okay, 10% discount. Okay, pay 450. So we are adjusting the value. Usually, we will be reducing the value of the money so that we know its value today. Money that we will receive in future, what is its value today? What is its value today? Like you said in your example, that if I give you $1,000 in 2 years' time, you might not be able to buy what you want to buy today in 2 years' time because the price of the thing might have increased. That means that the value of the money has reduced. All right, the value of the money has reduced. Therefore, you prefer it now whilst it has greater value today than in the future. So that's what we mean by discounting. Adjusting the value of money that we would receive in some future date to its value today. In other words, if I want $1,000 in future, how much must I put into some account today so that I can get $1,000 in future? You can think of it that way. Not exactly, but you can think of it that way. Then the second point here says that discounting is in effect the reverse of adding interest. Discounting is in fact the reverse of adding interest. All right. So let's look at some examples here. We have some money now, which is presently, this is 1 year's time. This is after 2 years, 3 years, 4 years time. All right. And we have, what is the value of $1,000 now? What is the value of $1,000 now? Its value is $1,000. If I have $1,000 now, it's better than waiting for 2 years, like you said, to receive $1,000. But what is the value of $1,000 in a year's time? This is where discounting comes in. The value of $1,000 now is 909. The value of $1,000 now, the value of $1,000 that I would receive in a year's time, take note, 1 year is 909 today. Am I making sense? Give me some feedback.
No. Can you please repeat it?
All right. So, if I want $1,000 in a year's time, if I want $1,000, then this is 1 year. If I want $1,000 in a year's time, and there is a savings account that will pay me 10% on any money that I put in that account, and I go to the bank and I ask them, how much do I need to invest today so that you will give me $1,000 in 1 year's time? The bank will say, well, based on our interest rate of 10%, if you invest 909 today, you would get $1,000 in a year's time. But how about that? Do you understand that?
Yes, it makes sense now.
Yes, that means that the value of $1,000 in 1 year's time is 909 today. This is the value of $1,000 today. In 2 years, if I want $1,000, I need to invest this amount, 826. Now, So the present value of $1,000, which I would receive in 2 years' time, is $826. The present value of $1,000 that I have to receive in 3 years' time is $751. And the present value of $1,000 in 4 years' time, based on this interest rate of 10%, is $683. And the bank is able to calculate for us these values based on what we call a discounting rate or a discounting factor. Like we said, discounting is the opposite of adding interest. So if I want to know how much do I have to put in your account today, in the bank's account today, to get $1,000 in 3 years' time, I go to my table, I go to my discounting table, and then I check 3 years. Oh, the discounting rate is 0.751. And then they multiply 0.751 by 1,000, and I have to pay $751 today to receive $1,000 in 3 years' time. Now, I've noticed that with the trend of past questions and from our course book and our workbooks, that they will not ask you to calculate how to calculate the discounting factors. All right, but you would be required to know that at a higher level at the university, you would be required to know how to calculate the discounting factor. And this is the formula. I just put it here so that you know how it is calculated, but it is not in your textbook, and you're not required to know or memorize this formula. Only this one. All the other formulas we've seen so far, you are required to know. But how do they come up? I just wanted to demonstrate how they come up with these discounting factors. How do they come up with it? It is 1 divided by 1 plus R. R is the interest rate. Here the interest rate is 10% to the power n, where n is the number of years. So if you are calculating for 3 years and we want to know the discounting factor for 3 years, it is 1, that is 1 divided by 1 plus the rate of interest or the rate of discount, which is 10%, bracket closes, to the power 3. So that because it's the 10th year. And that will give you 0.751 if you punch this on your calculator. So if you have your calculator close by, use this formula and find and check if you would get 0.683 if you put 4 here as n, and then you replace r with 10%. And remember, 10% is 10 divided by 100, so that's 0.1. All right, so you put r will be 0.1, not 10, but 0.1 because it's 10%, so 0.1, and check whether you get 0.683. That should take you just about a few seconds.
Okay.
All right.
$0.683.
You got it? Great. All right. So let's conclude on this. What do we mean? What are we saying? We are saying that $1,000 today is greater or worth more than $1,000 in a year's time. All right. So today, the worth of $1,000, if we discount $1,000 today, you can see that it is still $1,000. If we discount $1,000 1 year, it is 900. The present value of $1,000 is 909. $1,000 which we will receive in 1 year time. The present value of $1,000 is 826 with a 2 year period, and then The present value of $1,000 is 751. Let me say it well. The present value of $1,000 in 3 years' time is 751 today at a discounting rate of 10%. Now let's come to a different discount rate. This is 5%. What is the value of $1,000 at 5% after in 1 year's time? It is 952. It means that I need to put more money now into that savings account that is paying me 5% to get $1,000 in a year's time. That means I need to put more money into a savings account, 852 compared to 683, because the discount rate here is 10, the discount rate here is 5%. All right, the third point here, the rate of interest plays a central role in discounting. The rate of interest in the economy, sometimes the interest, the risk-free interest rate. What do we mean by risk-free interest rate? Maybe the treasury bill rate, the rate at which government is borrowing. All right, the rate of interest plays a central role in discounting. That is the rate that is used to discount. In the same way as it does in predicting the future value of savings. That's why I use savings to explain what we mean by the present value of a certain future amount. The present value of $1,000 that we would receive in 4 years' time is 683. I'm just stressing it over and over again so that you understand it. And the last point, discounting tables are available to illustrate the effects of converting future streams of income to their present value. So this is a discount table. A discount table is a table with the various discount rates. These are the discount rates. And if you multiply the discount rate by the amount that we are discounting, it will give you the present value of that amount. And like I said, the discount rate will be given to you in the examination. If not, then we use this formula, but I'm sure it will be given to you. All right, so let's look more into this present value of future payments. Let's look more into this present value of future payments. Discounting expected future cash flow is the basis of calculating net present value. And that is what I have spent the time talking about here. The basis of net present value, is discounting some future streams of income, discounting future cash flow. And why is it future cash flow? Because let me go back. This cash flow that we see here is not now. Now we are expected to make a cash outflow. Now we are expected to pay for the investment, buy the machine, buy the company. And in 1 year time, it will give us 400,000. In 2 years time, it will give us 100,000. In 3 years time, it will give us 100,000. And in the 4th year, it will give us 100,000. We want the value of these payments, these future cash flows. We want their present value. How much is it worth now? That's what we mean by the present value. So discounting is how we will find what is the current or the present value of the money that we will receive in future. This method of investment appraisal forecasts expected outflow and inflows of cash and discounts the inflows and outflows like we saw here. All right. The future outflow is 1,000. The future outflow is 1,000 in all of these. It's 1,000 for all of these. But what is the present value of that 1,000? How much is that 1,000 today? If I should put some money into a bank account How much do I put into the bank account at 10% interest rate to get 1,000 in the future? I think I've overemphasized the point. I think you understand. Now, how do we calculate the net present value? Remember, we said that net present value is one of the three techniques, appraisal techniques that we are going to look at. All right, I've come back. The discounted cash flow model, under that, net present value is one of the techniques that we are going to look at. So, net present value, still on point 2, is a method of appraising forecasts expected outflows and inflows of cash and discounts the inflows and the outflows. So we want to know what is the present value of future cash inflows and outflows. To calculate net present value, we need these things. Number one, we need the initial cost of the investment, like we saw here. Here, the initial cost of the investment is $500,000. This is investment A. Its initial cost is $500,000. So the initial cost of the investment, the chosen rate of discount, and like we said, it is usually the interest rate. It is usually the interest rate. Where is it? Where did we see it? I think it's here. I cannot find it. All right, no problem. It is usually the interest rate, the rate of savings, the interest rate on savings. And then number 3, any expected inflows and outflows of cash. So number 1, we need to know how much will the investment cost. Number 2, what is the rate of discount. Number 3, what are the inflows? Very important. Without the inflows, we cannot discount anything. And then number 4, the duration of the investment. So in all the examples that we've seen, it lists the duration of the investment, year 1, year 2, year 3, up to the 10th year, whatever it may be. And then 4, yes, we've looked at 4, the duration of the investment. And then 5, any residual value. That's word again, any residual value. If it is a machine, what is the residual value of that machine? How much can we sell the machine for? So we buy a machine for $500,000 and it's going to be used for 4 years and it's going to give us these streams of income. But at the end of the 4th year, how much can we sell the machine for? We can sell the machine, if it is an obsolete machine, that is, there are new and modern versions of the machine, then we can scrap it, we can scrap the machine, we can sell it as scrap. So we sell it as scrap value. So if it's a machine which is obsolete, it is the scrap value or the residual value. How much can we sell the machine for at the end of the investment period? So if we have all these things, then we can calculate net present value. If we have all these things, then we can calculate net present value, which is very intuitive, like I say, for a lot of the formulas that we've looked at. Net present value is the discounted cash inflows, and we understand what we mean by discounted cash inflows now, minus the cost of the investment, which is the cash outflow. The discounted cash inflow minus the cost of the investment, which is the cash outflow. So the first point, let me read so that I don't miss anything. The first point says that net present value is calculated by subtracting the outflow of cash from the discounted inflow. So all the monies that we would receive from the investment in year 1, in year 2, in year 3, in year 4, all the monies that we would receive year 5, 6 up to 10, whatever the period is, all the money that we will receive in these various years, these future cash flows are discounted at a particular rate to know its present value today. That's what we mean by discounted cash inflow, minus the cost of the investment, which is the cash outflow. How do we take the decision? If the NPV, the net present value, is negative, don't do the investment. It is a bad investment. All the cash flows discounted today minus our cash outflow. Let me say that again. All the cash inflows discounted today minus the cash outflows is giving us a negative figure. It is not worth us undertaking that investment. It is negative. It's giving us a negative net present value. Why? This is because the present value of the streams of earnings, that is the future cash inflows, is less than the cost of the investment, which is the cash outflow. Am I making sense?
Yes, sir.
Sorry?
I said yes, sir.
Okay, glad to hear. Instead of wasting your money this way, a more profitable approach is put that capital, if it is $500,000, put that capital in an interest-bearing account, earning at least the rate of interest that was used for discounting. So instead of wasting that spending money on that investment, keep that money that you have, put it in an investment account or put it in a savings account with at least the minimum rate that was used for discounting. That would be a better use of our money instead of putting it into an investment that will give us a negative net present value. The last point here says the net present value figures rank net present value figures rank investment projects with the highest NPV, indicating the most worthwhile project. Businesses often select projects with the highest net present value. So if there are two investments, like investment A and investment B, and we discount the various cash flows, that is, we find the present value of these cash flows and we subtract the cash outflow from the cash inflows, and it gives us a positive figure, we would choose the highest one, the biggest one, the 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 investment that is giving us the highest net present value. We will choose the investment that is giving us the highest net present value. Any questions?
No questions.
All right, let's look at an example and then we'll bring our class to a close. We have some 15 minutes. We should be able to look at this example. So you are going to complete this table, but let's read the question first. And then I have the answers here, but I won't show you the answers. You complete the table and then we'll compare your table with the the answers from my table. All right. So let's read the question. Sailing Monthly is one of New Zealand's most popular sailing magazines. So this is a business that produces magazines. The owners of the magazine, Bureau Publishing, are investigating the production of an online editing. Oh, sorry. They are investigating the production of an online edition. All right. So this is a magazine, physical magazine, a hard copy magazine, and they want to publish, they want to go online, they want to go digital. All right. So they are investigating the production of an online edition, especially designed for tablet computers. The company has conducted negotiations with two software houses regarding the development of a website for its new product, e-sailing. So that's the name they've given to their online magazine. The physical magazine is called Sailing Monthly, right? And then they want to go digital, they're calling it e-sailing. All right, let's continue with the question. The two software houses offered very different ideas. One, proposal A suggested a basic product allowing Bureau Publishing to offer access to the magazine at a bargain price. Let me read that again. Proposal A suggested a basic product allowing Bureau Publishing to offer access to the magazine at a bargain price. Then the other proposal, B, proposed a more sophisticated product. Obviously, a more sophisticated product will be expensive. Here, it says at a bargain price, meaning at a good price. But the other one proposed a more sophisticated product to a higher technical standard, offering the opportunity for premium pricing. All right, let's look at the cash flows from the two options. So this is proposal A from one software company. This is proposal B from another software company. How much would it cost? What is the investment that would be required? The proposal A says the investment is $212,000. And proposal B said to cost you guys $451,000. How much will it give? What is the cash inflow? This one says it will give $46,000, $57,000, $63,000, $69,000 in the fourth year, $71,000 in the fifth year. These are the future earnings from the magazine, the online magazine, from proposal A, the software company that proposed A. Then the software company that proposed B says that it will cost you guys $451,000, but it will give you these outflows. So my question to you, Cheryl, is which is better, A or B? A, cheaper, the cash flows a little less, and B, much more expensive, but the cash flows are better. Sometimes twice of the cash flows from A. Which is better? Which should the company go for, B or publishing?
B.
So that is a good guess, but let's use net present value to calculate the present value of the future cash flows and then add all the cash flows and determine its present value. The one that has the greatest value is the one that the company must invest in. Can you do it? All you are doing is multiplying the cash flows by the discounting factor. And I told you that they will give you the discounting factor in examination. If they don't, we use this formula, the formula down here, but I know they will. So it has been provided for you. The discounting rates have been provided for you. Multiply these discount rates by the cash flows to determine the present value of these rates, and then tell me what is the number or the figure that you give me, that you put here, will determine whether we should go for A or we should go for B. Remember that this is a cash outflow, so it's a negative figure. So when you're adding all your present values, remember this is a negative figure. So you point negative 451 on your calculator, negative 451,000 on your calculator, and add the present values of the cash flows. You should be able to do this in 6 minutes. Start work.
Okay. I'm done. I sent the work. Hello?
Okay, let me see the solution that you sent.
Okay.
And then let's compare to yours. Let's compare to what I have here. All right, so for year, the start of the investment, it will be the same because you are just multiplying by 1. Remember, I told you that it is a negative figure, so it is in brackets. So when you are adding them up, you have to use negative for that. I hope you did that. This is correct. 41,814. This is correct also. This is correct. This is 47,100 years. This is correct also, but your net present value is not correct because you forgot that this is a negative number.
I didn't notice the first negative number. I only noticed the second one. My bad.
All right, but let's look at this one too because you didn't get 2,732. Oh, you did. Yes, you did. You did. You did. You got 2,732. So this one is correct. This one is correct, but this one you didn't realize that this is a negative figure. The cash outflow is always a negative figure. Never forget, the cash outflow is always a negative figure. So well done. At least you would have gotten half of the mark, maybe, or maybe 6 over 10, 7 over 10, because, but this is wrong. This is wrong. All these are correct. This will not carry much marks. All right, so well done. But this is the correct thing. So next time, we're going to look at investment appraisal decisions. That is another unit. I'm glad you have understood our class for today on the discounted cash flow model, specifically on net present value. If there are no questions, I will bring the class to a close now.
I
Any?
don't have any. No questions.
All right. Later. See you.
Okay.